Good morning. My name is Max Castelli. I am the head of strategy in UBS Asset Management. It is a pleasure to be here. Actually, I missed last year the conference in Cusco, so I was able this year to come to Arequipa, and it is a pleasure to be here. So I think some of the issues have already been touched, but the title of this session is Secular Stagnation, Saving Glut, and a Shortage of Safe Asset, ? I guess I think on the secular stagnation, probably the question mark is debatable, but let me add maybe a few introductory remarks that we run every year a big conference in Switzerland. We have been running actually for more than 20 years now. And the topic of saving glut and safe asset came out pretty strongly. We had many central banks participating in the conference. And actually, it is very interesting because and the question mark is very appropriate, in particular on the saving glut, because here we have two forces acting one against the other. The first one is that 2015 was the first year that we saw a dramatic fall in foreign exchange reserves globally, in the tune of, depending on how you measure it, and from which period, but I would say around $1 trillion. And also some sovereign wealth funds have been dismissing assets as a result of what happened in the oil price and in the intervention, in particular in China, on the FX market. So this in some way has taken away one of the main factors which has often been mentioned as the reason of the saving glut, basically the recycling of the sovereign wealth which is accumulated by either oil exporting economy or manufactured good exporting economy. But on the other hand, we are seeing that investment remains very low, and this creates an imbalance between saving and investing. So I think it's going to be interesting in the future to see if the saving glut will remain a future or we are going to see a reversal in the saving glut itself. The second one is about, of course, the shortage of safe assets. I read that the estimate of the number of government bonds with negative yields is going up by the day. I think we were about 10 trillion, now we are at 12 trillions. I don't know what is the latest number. But this is also a very interesting point, because when we were asked our central banks, and we run a survey every year of all the central banks participating in our conference, what is the major concern that you have from an investment side, so as manager of foreign exchange reserve, actually negative yield was the top one. And in fact, we are seeing, for instance, one of the major results that we saw was a migration away from the euro, which of course is one of the regions where we have quite a high amount of government bonds with negative yields. So these are all interesting topics, and I'm looking forward to hear our three experts. Without further ado, let me give the floor to Pierre Landau, Professor of Economics and the former Deputy Governor, Banque of France. Please, Pierre, the floor is yours.
Okay, so very briefly, the current situation, everybody knows, very uncertain prospect on world growth, with very frequent downward revisions by the IMF and the G20 about the growth forecast. Very low inflation everywhere and very low inflationary expectations everywhere, even in those economies like Germany where the GDP is moving very close to potential. Durably low interest rates, equilibrium interest rate, and here I can only subscribe to what José Manuel said a few minutes ago, and periodic bouts of global financial volatility. So this is a very very special environment. And I think it's very interesting and a little bit scary at the same time, that we have at least two or three competing explanations for what we see now, and that those competing explanations are may be seen as equally valid, and they lead to very opposite policy prescriptions. So, of course, the first explanation is that we have an excess of debt in the world economy. We are at the top of a debt super cycle. This is a Rogoff theory. The problems are on the liability side of the world economy, and we should reduce debt before anything else positive can happen. The second explanation is exactly the reverse. We have uncertainty, which is inhibiting investment. We have insufficient chronic demand. This is secular stagnation assumptions. And the problems are on the asset side of the world economy, and we should take care about investment and not that much about that. And the third one, which is, I think, closely related actually to the first one, is what I would call the BI's view, which is the low interest rates that we have now as an artifact of abnormally permissive monetary policy. And those monetary policy create financial instability, financial volatility. They encourage misallocation of resources. And this third view, of course, I will not develop it, is moving very, very close to the first one. And it's a kind of modern version of the Austrian theory. You shouldn't let the debt cycle to run its course. You should clean up the balance sheet, whatever happens. And this Austrian view is very much defended by the BIS. So what does the superior debt hypothesis prescribe? It prescribes the priorities to repair balance sheet, if necessary through debt reduction. Very interestingly, you see a sort of echo on that theory on the G20 approach, current approach under the Chinese presidency on what we should do at the debt at the international level. So we should have collective action clauses, we should have GDP index-linked bonds. All this is discussed in the G20. So there's this idea that debt is a problem, including at the international level, it should be dealt with. We should have, of course, accommodative monetary policy. We should not have accommodative monetary policy. They lead to zombification in the financial sector, and there is an increased risk of financial stability. Now, the secular stagnation assumption says exactly the contrary. They say we should keep monetary policy accommodative to align policy rate on the equilibrium level. And again, I think José Manuel struck the right chord a few minutes ago. We should engage into public investment, as private investment is inhibited by uncertainty. I call that the Kennedy's Airport syndrome. You know the famous sort of Larry Summers statement. We all are very unhappy with Kennedy Airport, and we all said this is not the moment to repair it. Well, if that's not the moment now, when is it? So that's the basic argument for public investment. And more generally, of course, the secular stagnation view people think that supportive fiscal policies should be a priority. So this is exactly orthogonal to the debt supercycle hypothesis. And one should honestly recognize that honest people can have the two views, and it's kind of scary that the two views can be valid, and they lead to opposite policy prescription, and that by itself creates a lot of uncertainty of what kind of policy regime we should adopt at the world level. My preferred assumption is, of course, secular stagnation. I will explain why in a few moments. But I also think that the way we talk and we deal with debt, both in policy and statements, is very important, because that's a condition for getting us out of the low inflation trap. And this is because debt plays, in my view, and this is a very personal statement, debt plays a big role in the current uncertainty. So why is a secular stagnation for me an attractive assumption? Very, very clearly, low level of investment, despite the most accommodative financial conditions indicate. No country in the advanced world has reached the GDP, investment to GDP level they had before the crisis. And this is in full contradiction with the sort of profile that we had in previous recession. So there's something very specific here, which is inhibiting investments. Corporates, if they had too much debt, they would stop getting into debt, and they've actually been getting into debt at a very accelerated rhythm, both in emerging and in advanced economy. There's no deleveraging taking on, and actually corporates are leveraging. So that's the sort of goes against the view that there are too much debt and debt is impairing balance sheet. Part of this debt is, of course, high yield, so it's a kind of very fragile situation, or is used to buy back share, and the word has been used by eminent central bankers. The corporates are looting the future, they are piling debt, buying back shares, and so they are putting themselves in a very fragile situation. And profit shares are very high, as well as cash holding, and Governor Carney, who has been mentioned already in the previous presentation, has mentioned that has coined the term of dead money. Dead money, this is the $5 billion of cash that corporates are holding over the world. And why would they do that? Why would they do that in an environment of low interest rates if it was not for an exceptional uncertainty? So why do I think that although secular stagnation is very important, we should still think about how we deal with debt? This is a kind of very schematic view of how the kind of struggle we are facing. I think uncertainty is, of course, at the center. Uncertainty inhibits growth. Debt may be creating uncertainty depending on the way we deal with it. This is not only a question of the debt supercycle. I will come back to it. And, of course, secular stagnation comes from insecurity, anxiety, system, policy. I'll go to it. And all this leads to low growth and low equilibrium interest rates. So uncertainty and secular stagnation. Uncertainty inhibits investment and stimulates saving. So in my view, uncertainty may be the dominant factor today explaining why we have so low equilibrium interest rates and why the saving gluts may be there, as Massimo mentioned. It's obvious that when things are uncertain, there's a huge option value in waiting. I will give a few examples. And so uncertainty inhibits any kind of investment which has a reversibility element attached to it. No one wants to go into a reversible investment if there's uncertainty, and if, of course, the opportunity cost of holding cash is nil, then there is no penalty in doing that. Source of uncertainty, there is, I must say, and this is reflected in a speech that Governor Carnes made 2 days ago, but I made that slide before. Is that there's a new combination. We have geopolitical uncertainty, obviously, it's very important, and we have strong economic words by Gordon showing that this leads to higher risk premia on equities, for instance. If we have a lot of tail events risk, very small tail, very big events with a small probability can increase the risk premia. We have a lot of technological uncertainty. We mentioned this morning the uncertainty affecting the banking sector, but many sectors may be affected by automation, by robotization, by artificial intelligence, many jobs may be lost. This has created a huge uncertainty at the 10 years horizon. So why would we engage into investment with that? Why would you invest into a car industry, into a car factory, if you don't know which cars will be circulating in 5 years on your roads? And this is actually, I think, the situation. We don't know whether it will be electric car, semi-electric car, self-driving car, semi-self-driving car. Why would you invest 5 or 10 billions in the car factory when you don't know that? So I think technological uncertainty is very, very important in the current environment. We have systemic uncertainty. I think that will be developed later on, but I will mention briefly the kind of financial volatility, the changes in the global capital market which create uncertainty. We have obviously economic inequality and insecurity, and we have policy-induced uncertainty, which will be the major topic of the slides that will be coming up. So if we try to classify them, we have complexity, anxiety, policy. It's a little bit flashy, but it's complexity. This is an example. This is an example of the structural changes in financial markets. So it's pretty clear to everyone that the financial intermediation, cross-border financial intermediation that changed over the last 5 years. It's less and less bank-driven. It's more and more portfolio flow-driven. And portfolio flow do not fully react to changes in fundamental of risk perception as bank flow react. They are much more sensitive to risk perception. They are much more volatile. They are much more fickle. They introduce much more price fluctuation than banking flows, and they are a little bit non-linear. So if you have a small change in risk perception, you can have huge movement in asset prices and huge movement in capital flows. So we saw that, of course, when we have the temper tantrum and the bond tantrums. So small changes can have big effects. This is non-linearity. This is creating an additional complexity, and I think a lot of emerging economies are still struggling to deal with those non-linearities. It's creating a more complex system overall. Anxiety. Here, I just think I should quote fully a very nice column that Bob Schiller made like a year and a half ago, which is that anxiety and uncertainty are weighing on individuals even when the overall economy is growing. This has been written in February 2014. This may be the best explanation of Brexit. A very healthy economy, all the fundamentals correct, low inflation, strong growth, in the process of balancing their budget, no unemployment, and still we had this manifestation of anxiety which the Brexit vote shows us. Some of this angst is the fallout from advancing information technology, I agree with that. Along with this enormous problem is the psychic cost of growing income inequality, and you say, I suspect there's a link to explain why it's not just short-term interest rates that are very low, but long-term interest rates. So this is one a Nobel Prize winner, one of the biggest thinkers about finance, who tells us, I have no proof, But I strongly suspect that people are in such an anxiety that this anxiety is driving down interest rates. I found that very, 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 very interesting, very strong. And I think Brexit shows that complexity and anxiety sort of fuel each other in the world economy. And that the reaction of public opinion now, which we were not, no one able to forecast accurately, the reaction of public opinion, what's happening, and again, in a country whose fundamentals were basically very, very strong, are basically very, very strong. So the reaction of public opinion is creating this kind of abrupt policy changes and abrupt rise in uncertainty, which is sort of creating an additional feedback loop in an already very complex world. So for those of you who are in charge of trying to manage globalization, I think this is an additional challenge, and that you cannot ignore the possible reaction of public opinion when you manage globalization, whatever it's on monetary, on the trade field, or on the financial field. It creates an additional degree of complexity and therefore uncertainty. So anxiety, complexity, uncertainty are closely linked. Now, what can policymakers do to sort of face such a situation? Well, they can, at the very least, avoid to introduce additional uncertainty through policy regimes which are not clear to perceive by the private sector. This is the message of this slide. Actually, I should have called that slide "Expectations Matter." And policy frameworks influence expectation. So if you want to reduce uncertainty, you should have stable and predictable policy frameworks. This is not the case today in the global economy. No. So expectation matters. I skip over the financial consequences. It's obvious that markets are not anchored when the policy regime are not stable. I go to the real consequences. And I think this is the fundamental Keynesian assumption that people make expectations over the long run, and if those expectations are unduly pessimistic or cannot be anchored on some certainty, then the overall equilibrium goes down. And I think that's part of the policy consequences. So, sorry, I'm pushing on the wrong. So just very quickly, before I turn to the macro, very, very quick, three examples of policy-induced uncertainty. One is very far away from our meeting, but carbon prices. We all know that carbon prices are going to rise in the world economy. We don't know when, by how much, and to which level. So everybody, the things I said about the car industry in a minute is also worth on the energy sector. Who is going to choose a technology for investing in energy production when you don't know where the carbon prices is? That's a typically policy-induced uncertainty, which is, in my view, weighting very, very heavily on investment. Capital requirement on banks, I agree with what José Manuel said. The worst thing is about uncertainty about capital requirements. And in the last 2-3 days, you saw two things happen. You saw, I think, a very smart move by the Banque of England, which was announced this morning, where they would say they would allow the British bank to use their capital buffers to develop lending in the current uncertainty. So you had a very strong, predictable policy reaction by one central bank. And on the other hand, you have this debate about recapitalizing banks in the euro area and the role of bail-in, which is creating, in addition to what everything José Manuel mentioned, additional uncertainty. So I have no firm idea what the appropriate capital requirement regime. I believe, and I think that José Manuel said the same thing, it should be now stabilized and predictable at whatever level regulators want, but it should be predictable. Otherwise, we have this kind of policy-induced uncertainty. And we have, of course, this is now an ancient, but everything which goes into the capital account regime and exchange rate regime is also creating a lot of uncertainty. And I think everybody was surprised by the overall global impact on one small changes in the exchange rate regime by China at the end of last July, and the overall impact it had on everybody's perception. So it shows that when some big players have even a small uncertainty on an essential part of its policy regime, it has big impact on the rest of us. So having policy certainty, or at least policy predictability, is essential. What do we need to ensure that? We need a robust architecture, and we need buffers. And I think I expect, Massimo mentioned that foreign exchange reserves had been stabilized and decreasing for the first time. I expect them to start increasing all over again as soon as circumstances permit, because this is a rational way to protect yourself against uncertainty if you are exposed to the non-linearities and shocks of capital flows, unless you have an international regime of liquidity provision. And of course, you must have a credible reaction function for public authorities in fiscal policy, in monetary policy. So now I'm going to venture into a very personal statement. First about fiscal policy. Here are three statements which are sort of caricatural statements of current policy. First one is, I will certainly raise taxes in the foreseeable future, but I don't know when. So that's Japan, of course. And that is creating a lot of uncertainty. If you have a household, you know you're going to be taxed, maybe next year, maybe the year after, maybe in 2 years. It's very straightforward to understand this is creating uncertainty. Now you have a second statement. I will improve structural balance by 0.5% of GDP, whatever happens, but I don't do it. That's Europe. Again, that's creating uncertainty, right? So the first statement, I will bring back debt to GDP ratio by 10 to 20% GDP in the next 5 years. That is a robust statement. That is the German fiscal policy, and that used to be the British fiscal policy until three weeks ago. That is a very robust statement. The problem is that if everybody has that same robust framework, what does happen to the world economy? So we have a kind of sort of cooperation problem here, a kind of composition problem here. That's a robust statement. Is it consistent with robust growth in the world economy? So are we, by our sort of flip-flopping on fiscal policy, are we creating what we want to avoid, which is Ricardian situation, where people are so afraid what is going to happen, they are totally paralyzed, whatever you do. So if we do that, we got the worst of possible world. We got into higher debt, fiscal deficit, and no impact on the situation. And I'm afraid this is a very, very good case of policy-induced uncertainty. Now, to come back to what I said at the beginning, there is a big sort of contradiction between what we do on debt and our aspiration to reduce uncertainty. Uncertainty, when it props up, creates the need for more safe assets. Massimo mentioned that, and that will be my only allusion to safe assets. We need more safe assets for foreign exchange reserves. We may need more safe assets for collateral, and there is a general flight to quality. You recognize uncertainty when there's a flight to quality, and that's part of the reason why you have 2 trillion debt with negative interest rates at a 10-year maturity. Part of it. So uncertainty creates a need for more safe debt, but since we diverge on what we should do about that, and when we diverge whether debt is important or not, we're actually creating additional uncertainty, so more demand for safe debt. And at the same time, we are retiring safe debt from the market. And debt which used to be deemed as safe is seen as less and less safe if we introduce CACs, if we introduce... So I stay away. I have some bad... So this is why I said at the end of the day, I think the G20 and the rest of us, we should agree on whether debt is important or not, whether it should be reduced quickly or not, whether there is room, as I think, for an expansion of public debt and actually a need for an expansion of public debt if we think that safe assets are needed. But the current divergence is getting us in a very deep contradiction between the general sort of statements that we want to reduce debt and the need that we create for more debt and for more safe assets. I think that's, if you go to the heart of it, I think that's why we are in this situation today of low inflation, low interest rates, and increased uncertainty. Now, I have no proof, but I just came out. This is the latest blog by Banque, and he has this very interesting picture. So it's not very clear, unfortunately, but you see the 2 main lines on the top, which are the attitude of people about personal, it's for the US, the attitude of people about their personal finances and whether they think they're going to be better off in 1 year. Right? And those two graphs, they go up in the last year. And then you have this graph which you don't see here, which is how do you think the world is going, better or worse? And there's a disconnect there is a disconnect. And that disconnect has appeared in every previous recession, but it has self-corrected itself after a couple of years. And the singularity of this recession is that it does not correct itself. So we have a pronounced disconnect of the assessment that people have about their personal situation in 1 or 2 years and whether they think the world is going better or not. So their long-term perception are diverging for the short-term perception in a very significant and prolonged way. So I don't pretend to have an interpretation of that. And Banque comes up with a few sort of speculative questions about this, whether this is not a sign of political polarization and social polarization. I would say, personally, if there's a divergence between long-term perception and short-term perception, people have worry about the long term. And one reason that people may be worried about the long term is about debt. And we keep worrying them about debt. So maybe debt is part of the reason why short-term perception and long-term perception are so diverging. And there should be some. Last slides, monetary policy and uncertainty. That's quite standard. Monetary policy by itself cannot fight uncertainty, which is created either by the situation or by other policy measures. Monetary policy, if it's not well conducted, can aggravate uncertainty if the reaction function is ambiguous, like in other policy matters. That's why I see the importance of symmetric mandates, very symmetric mandates, and firmly symmetric mandates, which means in the case, in my view, in the Eurozone, that we should be more explicit. They should be more explicit about how they can converge to the target, whether it's as valid to converge to the target from the upside, but from the downside, which means that if there is a couple of years with slightly above target, that's not an issue. And that would be, in my view, the right way of impinging some symmetry, of imposing some symmetry in the target. And here I would sort of try and complement what José Manuel has said. It's true that the trade-off between the benefits and the cost of policy which are conducted is worsening. And we may be reaching a sort of balance there. That is instrument uncertainty. Whether instrument uncertainty should lead to a weakening of the signal to reach a symmetric mandate, I think is a question we should ask. I think personally, in the current circumstances, the policy reaction should be perfectly predictable. The mandate should be perfectly predictable, and the instrument should be in line with that policy prescription and with the mandate, even if they have increasing negative side effect. Otherwise, it means the central bankers are signaling that they're comfortable with not reaching their mandate, and again, that may be creating additional uncertainty. And obviously, pure data-driven exit from forward guidance is also by itself a factor of additional uncertainty. Thank you very much.